Good afternoon, everybody, and welcome to Essentials. My name is Dale Franklin, and I will be hosting you today. Please make sure that if you want the CPD point, that you stay on for the full hour. And if you have any questions, please put them in the Q&A function, and we'll try to handle as many of them as we can today. Our speaker today is Mike Gresty. He's head of equities for Anchor on the local side. And today we have a very interesting essentials: when to hold them, when to fold them. I think all of us have had a love affair with the local equity sector, and it's certainly one where it can be your dream or your nightmare, because it really shows your mettle as a stock picker, and you really have to know when to hold them and when to fold them. So without further ado, let me hand over to you, Mike.
Thank you very much, Dale, for that introduction. I'm certainly going to do my best to keep you gripped for that full hour so you get those CPD points. I'm just going to share my presentation if you give me 1 second. Okay, great. Well, good afternoon, everybody, and thanks for your interest. So, what are we going to talk about today? I've entitled the presentation "Getting Real About Investing in South Africa." I'm quite excited to share a body of work that we've been doing, which sort of digs under the bonnet of what's really happening at a sort of macro level within the South African equity market. And how do we think about investing in this environment? And as Dale said, it's a very difficult market, over time, and I think getting more so. So we're going to talk a lot about that, and really getting to grips with playing the ball that you see coming down the pitch at you as it stands today. So what are we going to talk about? We accept that the South African equity market is cheap. I think everybody acknowledges that. But I think that is a single dimension that you need to look beyond when you consider the approach that you have today to investing in South Africa. And, we're going to go through a number of factors that you need to keep in the back of your mind in terms of, as I entitled the presentation, being real about investing here. And importantly, after last year's outperformance, in absolute terms, it wasn't a fantastic year, but compared to what we saw offshore, South Africa was certainly a relative standout. Maybe that breeds a degree of complacency in terms of thinking things are easier or better than certainly we see them. And then being realistic about that. If you think back to why was it that we outperformed, I would say it's probably two things. Undoubtedly, we didn't start at the beginning of last year with our equities in South Africa in anywhere like the bubble territory from a valuation perspective, and that definitely helped us. We didn't have to go through that huge adjustment that we saw, particularly in the US, as suddenly the world had to adjust to much higher interest rates. And then, absolutely, we were one of the markets that got very lucky in terms of who benefited from Russia's invasion of Ukraine, given our commodity exposure. So we got a bit lucky. Valuation certainly bailed us out. But as we stand here looking forward, what do we think now? So I'm going to take you through a couple of themes now, just looking at, some of the practical realities of our South African market. Some good, some bad, but really important in terms of the strategy that we think one needs to follow when you invest here, because there are some real unique challenges that we face. So first of all, just that point on valuation. Yep, not going to deny we do look cheap. First of all, if you look at the chart on the left-hand side there, that's just our PE, forward PE over time of the South African equity market. And you can see, at the moment, despite a decent start to the year in terms of equities, we're still at levels where we're at close to the lowest rating we've seen in South African equities in upwards of 20 years. So no denying the absolute valuation is attractive, and you can see that this sort of decline in rating is something that we've really been living with since pretty much 2017. If you look at us in relative terms on the right-hand side there, I've shown how our valuation looks compared to developed markets, which is the dark blue line, and our peer group of emerging markets. And in both cases, we're looking pretty cheap relative to history. So that looks great, and there's no denying that. There's a strong case to be made. You buy in at expensive levels, your subsequent returns are going to disappoint, and vice versa. So certainly a big tick in the box for South African equities from a pure valuation perspective. But that's just one dimension. So let's look at some of the other things and how they've changed over time. So this next chart is just showing us how over the last 20 years or so, the pool of listed investments in South Africa has shrunk. And it's sadly, you've seen a situation where if you sort of aggregate the data over time, our listed universe is pretty much halved in terms of absolute number of shares. The other point to observe there is just the fact that certainly in the last 5, 6, 7 years, we've seen a consistent stream of companies heading for the JSE off-ramp. The other point I'd probably make about this slide is that, when you see a picture like this, unfortunately, what tends to happen is your market becomes a little bit stale. Ideally, what you want to see is that your listed equity market is constantly refreshing. You're getting exposure to new themes, new growth areas, be it technology, be it biotech, for example, if we think in a more global context. Unfortunately, if you're not seeing those new businesses coming to market, your market increasingly starts to resemble, the last century. That's something that's been very apparent in Europe, and to some degree, we've got no exception here. I don't want to overplay this. I mean, it does sound quite negative, but it's important to understand that this has certainly been a theme playing out. If you look at perhaps to sum up in very generalist terms, the type of companies that have been listing over the last 10, 15 years, tended to have been quite a sort of predominance of property companies, sort of NAV plays, BEE, conglomerates, that sort of thing at times. And certainly we haven't got that sort of vibrancy of interesting new opportunities that you would like to see in the market. So, yep, we're now at a level where at an aggregate number of companies, we've got around 300 listed shares on our market. But then when you add this next issue, which is understanding how size has begun to become an increasingly binding constraint on money managers, it presents quite a scary picture. So what we've done here is we said, given, this is a sort of matrix where we said, given various fund sizes, billion rand, 10 billion, 20 billion rand, and a desire to hold a 1% position, 3% position, 5% position in an individual equity, and then overlaid with that some practical risk limitations to say we would like to trade in and out of that position in no more than 3 days. And it's unlikely that you're going to be able to, given the number of fund managers trading on any given day, realistically be able to secure more than about a third of the average daily value traded without having a really big impact on the share price. What does that actually mean practically for you in terms of the number of shares that you can look at to remain within those risk limits? And, I would argue that realistically, a position of anything less than, let's say, 3%, it's difficult to have any real impact on the performance of your fund if you're holding positions smaller than that. And you can see how much that universe of shares that you can actively look at shrinks unless you're prepared to relax your risk parameters. So, and I think just keep this in mind as we look at some of the other pictures of the South African market going forward, is this major problem with how liquidity diminishes, given the size of your fund. The next thing concerns the cyclicality of our market. And this is a real challenge in terms of managing equities through time. I'm often envious of money managers in other markets, S&P in particular, perhaps, where I think you can be, you can cope quite comfortably without having any view on mining shares. And as a result, you can concentrate your entire career on businesses that are much less volatile and much more predictable. So in this chart, what I've shown is just the weighting of energy and essentially mining shares within the JSE. And the other chart, other gray-brown line there is just showing technology services. And the reason that I've shown that is because that's predominantly Naspers process, so a single stock. And the two things you'll see here is certainly, back through history, there have been many times when let's call it cyclical miners and resources have represented more than 30% of our market. Where it fell away, certainly the nadir of miners was around 2015, 2016. Subsequent to that, it didn't grow terribly quickly in relative terms, but that was largely because Naspers was going through a real bumper period and was really dominating our market. So you had a situation around 2020 when, if you add those two lines together, almost 50% of our market was made up of a single share, Naspers process, and miners. And it's particularly the exposure to these cyclical companies that is something I want to highlight. And why do we care about this? Just to talk quickly to the table on the right there, you can see how we compare to other markets around the world. FTSE would be another example of a market with this mining cyclical exposure is relatively high, but you can see how elsewhere in the world you could almost regard miners as a kind of voluntary sector. You can choose to delve into it or ignore it completely. And why do we care about this? Excuse all the spaghetti of lines here, but let me do my best to explain what we're trying to show here. So what I've done is I've taken a selection of mining shares, and I've really tried to pick not only a range of different miners, so an iron ore company, a precious metals gold miner, we've got Sasol in there, your oil play, we've got Impala as your PGM play, and essentially looked at their total return over time. So that's a combination of the share price performance and dividends. And what I've done is compared that to the same picture for a range of other companies listed on the JSE. Again, try to find a range of different sectors. So we've got a bank, we've got a luxury play, we've got a retailer. And what I'm trying to show here is that while we have been through a really strong upcycle for miners over the last 5 or 6 years, if you take a longer term view, these cyclical companies have not really been your friend in terms of delivering you that compounding return over time. Owning them at the right time, undeniably been fantastic investments, but as we like to say, these are the kind of shares you want to date rather than marry. So, it makes it a very difficult market in which to simply buy a portfolio of shares and go away and forget about it and expect that, time is going to be your friend. It does require one to be a real expert on understanding the cyclicality of these miners. And certainly what I've found is that, that it's a real area where you've needed to be a contrarian. And particularly that comes with the timing of when to exit, because it certainly is a sector where when the story seems to be at its absolute best and most bulletproof in terms of investment case is probably the time that one should be looking at exiting, and vice versa. I think back to around 2014, 2015, when my colleagues were talking about mining shares and we all used to open the paper because we felt that this was a complete sunset industry. And that was exactly the time we should have been paying much more attention because it was literally the beginning of the upcycle. But important point to note is we have a very high exposure to cyclical companies that one has to be very active around your timing of investing and exiting. This is not a natural world of sort of structural compounders. The next thing, this talks to what I've called our diminishing tailwind from growth. If I go back in time, it's always felt to me like South African fund managers are natural value investors. And certainly that has worked very well. It's hard to argue with a diehard value investor in terms of the logic for why investing with that style makes sense. But the thing that I've often worried about with value investing, and we'll talk a little bit more to this just now, is that value is often value for a reason. And when you've got strong economic growth at your back, I feel you get a much better environment for value to turn around and surprise positively. You get that effect of tide lifting all boats. But as you see growth diminishing, I think the risk around value often begins to bite you. And sadly, if you look at South Africa over varying periods of time, you can see that step down in average growth rates. And certainly we're living in an environment now where I think your margin for error in terms of the companies you invest in is so much smaller than it was in the past. And the difficulties and headwinds that, poorer quality businesses face in terms of, exposure of their weaker business models, weaker balance sheets, or whatever the reason may be for why those companies are rated relatively lowly, just makes them that much more vulnerable. And I think it means you've got to be a hell of a lot more thoughtful around why you hold shares in South Africa and what the growth drivers for those businesses represent, because you do not have that natural tailwind of a strong economy to bail you out. And I've just pulled this chart, which was something that MTN showed in its recent results presentation. I'm glad that I'm sitting in my office now without you all in front of me, because I think people are so tired of hearing about load shedding. I would expect to be stoned at this instant to show a chart on this. But, essentially what this shows is just how load shedding has picked up materially. I'm sure I don't need to tell any of you that. We're all living it together. But over the back end of 2022, MTN's view is that this is going to be a problem we're going to face at similar levels to what we're experiencing now for the next 3 to 5 years. And I simply put it out that it's very difficult to get excited about South Africa as a growth story when you have this binding constraint hanging over you. Now, as an offset to that fairly negative view on the sort of outlook for growth in South Africa, the question I put to you is, does it really matter? We've done an exercise here where we've looked at the earnings composition of the top 100 companies. We've literally drilled into every single one of them and looked at how their earnings are split. I've done it split between sort of non-mining shares and then total JSE. And the reason I've done it that way is it's very difficult to isolate where it is that mining companies actually sell their goods. So on the right-hand side there, we've just assumed that all mining companies' output is priced in dollars and therefore is offshore in nature. On the left, what's interesting though, is you look at the JSE ex miners, you can see that even on that basis, less than 50% of the JSE's earnings are coming from South Africa. You've got to be a bit careful to say, well, that's fantastic because we've got a wonderful rand hedge exposure on the balance of the portfolio. The reality is a lot of that non-SA exposure is actually in emerging markets. So be careful to assume that that's all high quality, very defensive, strong currency earnings. It's not necessarily the case. But it's safe to say that if you really want to, it's very possible in our market to build a portfolio of shares that doesn't look anything like South Africa. So as much as we have concern about the economic growth outlook of SA, it's not to say that that's particularly well represented in the JSE, and that can be a good or a bad thing depending on how you see the world. Now, let's talk about flows of money into SA. This is a really critical issue because certainly in terms of getting our rating up, you need to think about it in context of where is the new money coming from to invest in South African shares. Now, are domestic investors allocating more to South Africa? Are foreign investors looking at South Africa more closely? And what we're looking at here is a sort of long-term perspective of how South Africa's influence has changed over time within emerging markets. So this is a view that a GEM fund manager would have, and how the weightings of various countries have changed over time. And you can see if you go back to the period shortly after democracy in South Africa, SA was undoubtedly an unavoidable market. It was one of the biggest markets in the emerging markets index at close to 15% there. You had to be here. Today, that has shrunk to between 3 and 4%. A lot of that has to do with the growth of China, as you can see. And on the right-hand side, you can also get a sense of which are the most important regions in the eyes of a GEM fund manager. And you can see how absolutely today it's the Asian region that completely dominates EM. It's not to say that South Africa is completely insignificant, but given the allocation of one's time, you could easily argue that South Africa is starting to become a little bit more of a voluntary market as to whether you're here. Something else that certainly I've learned over my career talking to foreign fund managers when I when I started out on the sell side, is that in the world of emerging markets, I think risk is to a large degree taken for granted. If you're an investor in emerging markets, you're a pretty hardened character from a risk tolerance perspective. But what you really are is a growth tourist. So you're going to move in and out of emerging markets based on where you see the best growth prospects, and obviously looking at that from a perspective of where you're getting the best valuation relative to that. And unfortunately, as we looked at just now with South Africa's diminishing growth, we don't really stand out as a particularly attractive market in terms of the way a GEM fund manager would typically be looking at the world. And yeah, that's just the reality of it. It means that you really have to have a pretty sparkling stock-specific story to cause them to come and have a closer look at you. And then if we just have a look at again, on this theme of what's happening around flows, from a domestic perspective on the left, this is just looking at the Alexander Forbes survey. So it's giving you a perspective of what the larger fund managers have been doing. You can see over the very long term, that dark blue line, which is your equity weighting, that has diminished through time. And chiefly at the flip side of that has been an increasing allocation to offshore. You've also in recent times seen a little bit more allocated to bonds. In the last year or so, we've seen the allowable allocation in portfolios increased to offshore. My sense is, given the very volatile environment that we faced offshore in equities, fund managers have been a little slow to go up to the maximum permissible offshore allocation. But as that starts to normalize and we see better growth prospects for equities returning offshore, potentially you're likely to see fund managers allocating more and more to the offshore market. But you can certainly see it's not been a particularly positive picture in terms of the net flows into South Africa. And then on the GEM side, no surprises there that given our really unexciting growth story, we tend to be a structural underweight within emerging markets. And really for that to change, I think the growth story in South Africa would need to be seen in a very different light. Sorry, this is beginning to sound a pretty negative story, isn't it? It wasn't the intention, but as I say, it's really trying to give you that perspective on, the realities, if I can call it that, of what's happening under the bonnet with South African equities. And just a sort of final word on this big picture, something that I've been particularly interested in trying to understand. And I think it's probably the consequence of the aggregation of all of the stuff that I've been speaking about up to now, is what's felt like pretty much an abyss for small cap shares in South Africa. And so what we've shown here is a matrix of valuation on the bottom axis there, compared with the rate of earnings growth that a number of these smaller cap companies have been able to achieve over the last 4 or 5 years. And, just picked a selection of companies that we think have delivered an excellent operational performance, but it's just amazing to see how little that has been reflected in, the rating that these companies have enjoyed versus the broader market. And it's not to say that the JSE has done that badly. 15% compound earnings growth over the last 4 years. If you go back 4 years, though, it does pretty much coincide with the low point for mining earnings. And a lot of that strong growth that you've seen in the JSE has been driven by very strong growth in miners off that low base. But I think the point here is when you're faced with very limited liquidity, and these are shares that really, I think, live outside of the investment universe for all but a number of very small funds, the lack of new money coming in, and I suppose a lot of the issues that South Africa has faced in that regard, it's perhaps understandable why you're not seeing these smaller cap shares re-rating to the extent that fundamentals suggest that they should. I think these have largely been companies that have been confined to, dare I say it, more private investor activity. And given the volatility and risk aversion we're seeing at the moment, there's been a real slowdown, I believe, in the risk appetite amongst private clients. So yes, pretty sobering reflection on what is the environment in which we're investing in South Africa. So how are we approaching that practically? And what I'm going to talk about is a little bit about our philosophy and how we would recommend that investors think about what's a really challenging environment. And I'm going to pepper that with a number of share-specific case studies and ideas, because I think that's a really important aspect of what we're trying to do here today. And I've tried to include a number of companies, a couple of little controversial ones given what's going on at the moment. So I hope you'll enjoy that. But essentially, in a market that I think historically has been very value orientated, we take a slightly different tack on this. And we think it's become increasingly important, given the lack of support you're getting from that underlying economy, to actually focus your attention on quality shares. I think historically, South African fund managers as a group, and I'm certainly speaking in generalities here, have been very, very value focused. That as a result of that, they've been, with the benefit of hindsight, too willing to let go of high quality compounders purely on the basis that in the short term, they look expensive. And when we look again with the benefit of hindsight at performance of individual companies, undoubtedly that willingness to let go of your stars, you could say cutting the roses to water the weeds, perhaps, it's really cost performance. And I think that this is going to be more an issue going forward than it has been historically. The next thing is to consider that one needs to be patient. No theme is going to work through all of time. In fact, globally, we've been through a period where quality investors have really suffered. So this is undoubtedly a theme which you can't expect to work through every cycle. You need to be clear about whether you're a trader or an investor. So when we talk about trading, we're talking about people that have no more than a one-year view. Often that's a debate around macro, it's a debate around valuation, what's happening to PE multiples. The longer you look out through time, though, the less and less that matters. And the more and more it is about absolute earnings growth and the compounding of that through time. And it's really, as we talk about how we think about quality, it's looking for companies that we are confident are able to do that and do it consistently through cycles and have been able to demonstrate that. And I'll talk to that a little bit more just now. The next thing is that, we think, and it's kind of goes against what really it feels like we're living through at the moment, because there's an absolute obsession with debate around macro. And I can understand that. We're living in obviously very uncertain and challenging times. We spend hours and hours debating what the Fed's going to do, what's happening with inflation, what's happening with interest rates. And while I don't want to diminish the relevance of that too much, I think it's important to appreciate that in truth, these things, while they may have an impact on the short-term tactical trading and timing of when you get in and out of shares, realistically, the impact that they have on the operating performance of companies in the long term is probably far less than the sort of weighting of debate around these things deserves. So the point being, it's about doing your work bottom up on companies. I think probably the reason you don't see a lot of discussion around those particular things is that everybody has a view on the macro stuff. Not everybody has the knowledge, the effort, the inclination to do the work bottom up. But critical in terms of this market where you don't have much margin for error to do that work. So essentially what we are looking at is building a quality core portfolio that you don't mess with too much. You're aware of valuation that may cause you to upweight, downweight as opportunities present themselves. But generally, you stick with those companies through time unless something critically changes to say that that company is structurally different and is no longer deserving of that quality mark. Around that, sadly, in South Africa, frankly, we don't have enough companies listed here that really genuinely, in our view at least, tick that quality box. Given that absence of growth giving you a nice steady underpin, it requires you, we think, to be quite opportunistic about themes that change through time and on the lookout for those. It requires you to be very nimble around the balance of your portfolio and open-minded around, valuation opportunities. We'll chat to you a few of those in a couple of minutes' time. So it's a combination, call it a barbell if you like, of core shares that you are not easily going to be parted from, and then augmenting that performance with these special opportunities that can come from a range of different sources. And important to note, because they don't give you that moat of quality, you need to be much more careful around whether it is that your theme, for whatever reason you're holding those shares, is actually playing out, and be disciplined around exiting if there's any sign that that theme is not playing out as you expected it. So just looking at quality, first of all, the thing about quality is it certainly means different things to different people. I think in many respects, it's more qualitative than quantitative. And I think in different environments as well, different aspects of quality will have greater importance. So I've listed a few things that we certainly see as critically important. It's not to say that every one of our quality counters ticks these issues perfectly, but it gives you the sense of the kind of things that we think are important and what we look for. And, first and foremost, we're looking for companies able to compound their growth through time. They generate high returns on their capital, critical. That acts as a really powerful moat. It's very hard to compete with a company that generates high returns on capital and can outspend you in its field. They're highly cash generative businesses, again, providing you that moat. But importantly, it's that ability to compound through time. It's not simply a case of making high returns on capital. We need to be able to see clearly where those growth opportunities exist within your particular industry. In many cases, we're finding that incidentally in companies that have managed to transcend South Africa. So it does mean that there are, can I call it, a predominance of Rand hedge companies within our universe of what we would call quality, and you can see a number of them listed there on the right-hand side. And that's really because we think that they have a much bigger pool to play in terms of growth, where in many cases, companies that are purely domestic sadly are beginning to bump up against those growth constraints that I spoke about earlier. Really critical point is this issue of a solid, active management team. And when we talk about a few examples just now, hopefully you will see that come through. But I talk about active, and it means a hell of a lot to us. Yeah, the reality is I think of companies as being like big, heavy flywheels. You find that you get a fairly stagnant management team, as I call them, simply the occupiers of the C-suite. They don't do much. They don't make bold decisions. They're collecting their bonuses. That flywheel doesn't exactly stop overnight. But when they're not applying forward momentum to it and adjusting the business with the evolving market and opportunities, sadly, you find that the company begins to die a slow death. So we're very keen to see companies that are able to articulate a clear strategy around where they're trying to take it. It's not always to say that they execute it well. The market is, of course, littered with examples of poor acquirers. I'm thinking about Steinhoff as a good example of that, just sitting here, but there are many others. And so we're also looking for companies that have a solid execution. So a management team that talks the talk and walks the walk in terms of being able to do what they say through cycles. Importantly, not all of these businesses are cyclical. In fact, quite the opposite. There are one or two that would sit within that cyclical space. But, we would typically be looking to hold these businesses through up and down cycles. So those are a few things you can see when you look at our equity fund, how we've certainly walked the walk in terms of putting our money behind these grouping of quality companies where they're weighted much higher in our fund than they would be within the broader market. I would love to say that we had 100% of the fund in businesses like this. But as I said, I think it would be irresponsible from a concentration exposure perspective, given how few tick that box to be able to build a fund purely of businesses like this. So as a result, we think, before I move on to looking at some of the special opportunity ideas, this is a picture that I've stolen from a true doyen of the quality investing world, who I'm sure many of you are familiar with, is Terry Smith. And it's a little bit of a dated picture, and I'm sure there'll be a number of you out there who will be sniggering at the names that he's got there at the bottom, which are his more quality growth shares. And essentially, this is Terry's message around saying that quality growth typically stays quality growth. And if you buy poor businesses that may appear cheap, time is typically not your friend. And those companies listed at the top there, Marks and Spencer's, General Electric, Exxon, and so on, Yes, from time to time, they will have their day in the sun. Certainly Exxon's probably going through one right now. But in reality, if you look at how they've performed through time in terms of what their earnings have done, they've generally disappointed. And a key message that he makes is, certainly in his view, that the market tends to underestimate the sort of sustainability of growth of these true quality companies. Yes, of course, they will go through periods when, an issue will hit them specifically, but it's the ability to identify that as a potential opportunity to add more that probably stands out more in terms of the way he approaches the world. So he talks about the sort of enduring nature of quality growth. You don't often find that these quality companies move into cheap and nasty territory, and vice versa. It's always wonderful to hear those stories of corporate turnarounds where a poor quality company comes back from the dead, but sadly it tends to be the exception rather than the rule. And I suppose it's our natural love of always wanting to back the underdog that when you find those, it gives you particular satisfaction as an investor. But I think in truth, we would rather back the back form is the way we would see this through time. It's going to work more often than it doesn't. If we look at the shorter term opportunities, these are going to come from all sorts of different sources. And I suppose it's where your creativity and originality really starts to show itself. We've listed a couple of things that we tend to look at. Turnaround stories, I'd probably rank MTN as a share that we played as a quite a successful turnaround at times. It's certainly looking a lot better than it did, but it was regarded as almost uninvestable back in 2015. We've talked quite a lot about cyclical buys. Our fund would tend to be structurally underweight mining shares because we don't see them as those structural compounders. But there's absolutely no doubt that all of these sectors will have their periods in the sun. And if you can call those correctly and you understand the fundamentals well, you can make really good money out of that. So it's not to say we ignore the opportunities in miners. We will definitely play those. And, I think that's one of the advantages, I guess, of what our market represents, because it does give you those opportunities from time to time. Value unlocks, often an area where, be it an NAV breakup or something like that, you get a new management team in, for example, that are looking to unlock value, often find that it proves to be harder in practice than it looks like on paper. And you need to be very careful there that you don't end up with capital eternally tied up with a management team promising jam tomorrow and simply never delivering it. At the moment, some of the things we are orientating ourselves towards in terms of our fund, which falls outside of, can I call it, the pure quality component. We're certainly looking for a recovery in asset managers as we get out of this bear market. And those types of companies have been heavily beaten down. So we think there's an opportunity there. Generally, we're quite orientated towards what we call boring is beautiful in South Africa. So we think the banks are quite a safe place to hide at the moment. We wouldn't necessarily want to hold them through time, but their ratings are low, dividends are quite good. We've got a number of small cap options that we are holding at the moment that could give us really outsized returns should certain things come off. So those are some of the things that we are looking at in terms of trying to sort of scalp out additional performance. We particularly like the private education space as another opportunity in the South African market. And that's, an area where we think you're really trading against a gradual deterioration in the education provided in the government space. Something we'll talk to you a little bit just now. So I'm going to talk to you a couple of case studies of businesses, particularly in the quality camp, that we really like. And why do we like them? So for a long time, we've liked Bidcorp. This was obviously a business that was split out of Bidvest around 2016 or so. And it's one that we've had to be really patient with. The rating has never looked, other than perhaps at times through COVID, particularly attractive. It's been one of the more expensive shares. Has frankly been through a few ups and downs in terms of, a few own goals in certain emerging markets, had a fraud here and there. And then obviously we got hit with COVID, which is a complete black swan for a business like this. However, we've stuck with it and really backed a management team that we think are exceptional at what they do. And, the one call out I'd make particularly to the Bidcorp management team is how simply they communicate. And that's something that I really like, is a management team that can speak to you in plain English, and it's understandable, and they don't hide behind a whole lot of corporate jargon. This company really stands out for me in that regard. And essentially, we started to see our patience rewarded here. You're seeing, despite a lot of concern around how inflation would impact their margins negatively, the weakness in Europe, this business has really emerged, I would say, stronger from the cleanup that happened within its industry of competitors coming out of COVID. And you can start to see now that steady, consistent earnings growth beginning to come through. Another point that I would probably make, it reminds me of something I forgot to mention earlier on. We think in terms of quality investing, be careful of businesses that are what I would call hyper growth. Those tend to be the areas which attract the most attention from regulators, from competitors, and where perhaps the creative destruction is greatest. We like these kind of businesses that are more stealth players. They're a little bit under the radar screen. You as a consumer probably in many cases wouldn't even know Bidcorp because it supplies the restaurants you go to. And it's a real beneficiary of consolidating quietly in the background a very fragmented industry. For us, this is a perfect example of a business that has excellent, pedigree in consolidation, knows how to do it, and has implements through time, and is traditionally, outside of a thing like COVID, quite a defensive business. So this is one that certainly we stick with, we really like, and at the moment obviously gives you that rand hedge as well. Another one, Afrimat. This talks to that theme I mentioned earlier on about finding active management teams that are making a difference. So if you go back to around 2010, 2011, 2012, this was a boring provider of road aggregates, aggregates to road constructors, industrial quarrying, that kind of stuff. And the business has essentially transformed itself over the course of a decade into essentially what is now by and large a mining company. And in fact, earlier this week, Afrimat announced that it's actually changed sectors and has now moved into the general mining index, which probably is the final signal of how it's transformed itself. Now, what they seek to do is really occupy that, what they call kind of white space, where they're much smaller than an Anglo-American or BHP, as they put it. The kind of mines that they look at, the big boys wouldn't even get on their corporate jets to go and look at, but they're also too big for the Bucky Brigade, if I can call it that. And they've done a really good job in terms of finding mines where the Bucky Brigade have struggled from a capital perspective to capitalize the businesses properly. They've put money behind quality assets and run a very tight operation, and are now in a situation where, as a result of the acquisitions that it has made in the last couple of years, has essentially taken care of its growth for the next 3 years or so. And if you just look at it, and what I've done on the right-hand side there is indexed all of the miners back to 100, and you can see how over the next couple of years, Afrimat exceeds all of them in terms of potential earnings growth. Of course, this is going to be sensitive to what happens with commodity prices. Undoubtedly about that, undoubtedly that's the case, but at least in an Afrimat, you have the underpin of a management team that is adding materially to output. And these are the kind of differences we look for in businesses. And this is also a space which has been a very difficult one. And this team has stood out in terms of an exceptional set of managers in a difficult environment for miners in South Africa. Turning to transaction capital, I did promise you that there was going to be a controversial one that I would talk to. And this really, I put it up here specifically because when I think what I think happens with quality investing is you get relatively few opportunities to get into quality companies cheaply. And sadly, an uncomfortable reality is that businesses don't get cheap for no reason. And there's going to be two camps at the moment on transaction capital. Undoubtedly, lots of conspiracy theories coming out about management trading ahead of information that's come out. I'm not going to get into all of that. But what I want to stress is it's important to appreciate that this is a business that has developed over a long period of time a very good track record in both transitioning its business. On the left-hand side there, I've shown what transaction capital was made up of when it listed. In there was Bidcorp, which is a micro lender. It had Bidcorp, which looked after ATM machines, and you had their credit solutions business, debt collection. That Rand Trust was an invoice discounter, and a lot of these things are simply not there. If you look at transaction capital as it stands today, completely different business, and continuing to evolve as we speak, becoming more international. And despite this big transition in terms of businesses, they've been able to deliver exceptionally good growth through time. Yes, it's going through a period of challenge now, and a lot of people are reevaluating whether there's been a structural change in business. And again, lots of question marks around management. I would say objectively, this is a business we've backed for a long time. We really rate the management team. And when it comes to quality businesses that we back, we're not easily shaken from those views. And our natural tendency is to use these buybacks, these sell-offs as rare opportunities to get into quality businesses at an attractive valuation. They don't come along very often. Of course, your absolute nightmare, and something we've got to be very, very careful about, is whether there has been a permanent change in the nature of the business, because undoubtedly that's when you can lose serious money as a quality investor, when businesses genuinely do go from priced as quality to poor discount businesses for good fundamental reasons. And then finally, ADvTECH. This is just and I apologize for all the numbers there, but I think the critical issues to highlight here, the private education space is one that we really like structurally. And ADvTECH is our pick within that. We did talk about being focused on return on capital employed. We're looking for businesses that are generally superior return generators. And if you look at the three plays within the private education space, you've got Curo, which is very much focused on the schools space, has an interesting growth story of its own. But what we don't like particularly is it's a relatively low return business. And that's partly because of the fact that, schools are very capital intensive, space intensive. If you contrast that with a Stadio, which is a pure tertiary education play, much lower capital intensity business, that's something we like. And certainly Stadio is on the way up, a relatively early stage business. It's one that we certainly have no issue with. We quite like Stadio, and we would expect in time to see its return on capital continuing to rise. But what we like in ADvTECH is that it's a really nice blend of all of these themes. You've got the schools, the South African schools presence. You've got, a nice spread across income bands. It's got the tertiary presence. And very importantly, it's also got exposure into Africa. Now, why do we like this space? Certainly in their particular instance, it's a pretty unflamboyant management team. Again, something we don't like are, managers that love the spotlight. We often think where they're constantly in the press, how much time are they spending running the business? This is one where probably most people don't even know who the CEO of ADvTECH is. The other thing is, we're cautious of industries and businesses which have a high exposure to regulatory risk. It's certainly been an issue, particularly in Africa, has been the predominance of pretty irresponsible and poor regulation. Something we like about the education space, if for no other reason than self-interest from the regulators, that their kids are at these schools and the parents are generally quite influential people, you tend to find that there's a fairly light touch in this particular industry from a regulation perspective. And also importantly, when you talk about Africa, generally, this is a space that has a fairly low reliance on, municipal services and what have you. And these are obviously becoming very important issues in terms of ability to grow and where risks might lie. So it's one of the reasons we like ADvTECH, high return business and, fit for purpose in terms of what we see in Africa. And that's pretty much it from me in terms of our thoughts. I just want to conclude with a picture of our SA Equity Fund, which is, I suppose, where the rubber hits the road for us in terms of how we implement a lot of what I've been speaking to. In fact, all of what I've been speaking to you about for the last little while. This has been running as a unitized fund within Anchor for coming up on 2 years now. We obviously had much longer exposure to SA equities, and what we're doing here is frankly a continuation of our approach as we've applied it through time. But we're very pleased with how certainly that quality orientation has started to give us clear daylight versus certainly the benchmark. And it's a fund that has been for most of time in the top quartile in terms of the rankings. It has dipped briefly at times into the second quartile. And why I'm kind of particularly proud of that is I don't feel that the last 2 years or so have been a particularly supportive period for the quality investment theme. It has at times, coming out of COVID, felt like the tide lifting all boats. As I mentioned earlier on, if you sort of cast your eyes outside of South Africa specifically, it's actually been a very tough time for the quality theme in general. But we have absolutely no doubt that this is going to be something that's going to become increasingly important in terms of what differentiates one from the sort of underlying sort of macro constraints we face in South Africa, is that insistence on quality and the focus on long-term delivery of compounding growth through time. So that's really my story. I think I've left us a couple of minutes for questions if we have any, Dale.
We do indeed. Mike, you can stop sharing your presenter. And we've got a great number of questions. We'll try to get through as many as we can. If anyone has any questions, please also type them in now. We'll try to cover as much as we can. Our first question, Mike. Some fund managers say that SA is almost unavoidable due to PE ratios. Do you share some of that sentiment?
Dale, I do. I think it talks exactly to the way we started off this presentation. I'm absolutely not going to sit here and argue that South Africa doesn't look cheap. The problem is, as I suppose a key theme that we went through here is to say, is valuation alone enough of a reason to guarantee you performance? And a lot of what I've highlighted is why I would question that. We get into that ugly word of, is South Africa a value trap? I hope not. But we're managing and thinking about South African equities in context of what we see as a very challenging environment, and not presuming that there's an automatic entitlement to a re-rating. I think for that to happen, you need to convince yourself that there's going to be more money coming into South African equities, renewed interest in SA from foreigners. I don't want to sound like I'm complete hole in the donut person, but it's not my. I hope it happens, but it's not my base case. I'm managing for hard times and making sure the type of businesses we invest in are going to prosper despite, if it turns out better than what we hope for, put it that way, I'll be happy about that. But I'm not relying on that for our performance. And I think that's the way that people need to think about South Africa.
Mike, another question on the same theme, a little bit of a longer one. RSA has outperformed the MSCI EM over 1, 3, and 5 years now. Against the background of everything that has gone wrong in RSA since 2011, how much of the poor JSE results are unique to the RSA versus EM peers, and how much should be contributed to a DM versus EM cyclical story?
Yeah, certainly, again, I'm going to sound a little bit negative here. It's not necessarily how I intended, but I suppose to a degree, particularly given what we've seen over the last couple of years in EM, SA has undoubtedly been the least dirty shirt. We've seen some real black swans come through EM. If you think about what happened in Russia, where in the space of no time it went to zero, you've had some peculiar sort of government interference in Turkey, which meant as an investor you got completely hammered there. And then obviously what we've been through in China above all, in terms of the geopolitics, the regulatory tech onslaught, the tech regulatory onslaught, the way they manage COVID. A long list of things that frankly, EM has done everything possible to shoot itself in the foot. You contrast that with South Africa, which has been very fortunate in that it's gone through the benefit of a pretty decent commodities boom. Maybe you could argue that we could have done better from that had Transnet worked, all of those kind of things. I'm not going to go there. So yeah, South Africa, I think, has benefited from a combination of value, has been supportive, and the rest of the competitors have shot both their own feet off for one reason or another. And that's looking backwards. Looking forward, can we rely on those things to continue to cause us to outperform? I feel that the rest of EM, frankly, is coming off a particularly low point. China certainly seems to be doing more of the right things. And at the same time, I think perhaps we're coming up against greater binding constraints within SA that we've got to be realistic about. So yeah, that's history. Looking forward, I'm can I say skeptical that SA deserves to continue to outperform within EM. It's the only way I can put it. Given the sort of issues that we've spoken about today.
Mike, local heavy construction sector viewed displaying some tremendous value, but there's so few picks on the JSE at the moment. Which one would you currently favor at this junction?
Yeah, sure. This is a tough one, and we tried to play the construction recovery out of COVID. I'm still trying to recover pieces of my shirt from that, and right now we've distanced ourselves from it. I think the lesson I learned about it is that it is an incredibly difficult industry, and certainly a lot of the things we thought were going to happen simply didn't unfold correctly. There were, I'm not going to go into the specifics of it, but we've learned that this is probably the quintessential definition of a low quality cigar butt industry, if I'm honest. If I was forced to pick, I would probably go Wilson Bailey. It is a business that has got a long track record. I think it's done a hell of a lot to sort of reduce its exposure to SA, is a quality player, has the balance sheet to participate in those big contracts should we see them, and there's very few players left standing. That would probably be my pick. I know Marion Roberts has almost, it's gone from around 10 Rand a share to around 86 cents. That's no doubt it's a binary call there. Is that extreme value or a business about to disappear? It's certainly something we don't have the risk appetite to play. We would tend to want to back the best of the bunch in terms of quality and longevity, which I would go with Wilson Bailey.
Mike, next question, which is from a man named Mike Gresty. So I don't know if you're asking yourself this. We're circling back to transaction capital. Am I right to be concerned about the SA taxi loan book profile? 50% overdue, and again, half of that longer than 3 months, i.e. chances of recovery almost zip.
Yeah, it's a very good question. So it wasn't from me, but it's a very good question nonetheless. Yeah, there's no denying that transaction capital plays in a challenging space. I'm not going to deny that at all. What I do like is the fact that not only do they price for that, they have the uniqueness in the way that they run their taxi business and the kind of vertical integration with the refurbishment of taxis that they repossess. This is, certainly this is not an easy industry to be in. It's particularly one of the reasons we like the business is that they have certain moats that insulate them. They're a specialist in this game, and they have moats in terms of how they manage risk that it's hard for a Standard Bank or an ABSA to compete with. And I think that's the call that they've made, is that some of the cyclical exposure, what they thought was a sort of cyclical downturn, is turning out to be more structural in nature. I think that they will manage their way out of that. You're always going to find that there is going to be a high level of non-performance here. One of the things that I know from the length of time that we've been associated with this business is that virtually no loan goes to term. It's either paid off early by the successful operator, or it ends up going into bad debts and they process it through their system, they repossess the taxi, they refurbish it, and they recycle it into the industry. So, these guys are experts in managing that risk. But, this is not for sissies. I just know that they know what they're doing. I've got 20 years of doing this. I back them on that.
Mike, a question that'll take you back to your analyst days. Do you ever interview current or past staff of a business when considering making an investment into a business? And where there are questions around management?
I would say it's not something that we necessarily set out to do. I think if the opportunity presents itself, we would be interested to hear. I'm always obviously mindful of the risk that you get a person who's got some axe to grind. We tend to be more interested, frankly, in understanding the view of competitors. That's what I would more actively try to garner the opinions of. So it's a hell of an interesting question, and I'll certainly scuttle away and think more about that. But it's not something that we've actively pursued, to be honest.
Mike, last question for today, and I think a very pertinent one. Mike, as we approach the 2024 election year, how are you managing risk versus opportunity of what may come to bear?
Yeah, Dale, that's a great question. There's no doubt that we are reducing our exposure within SA. I think we've gone as conservative as we possibly can. We've tended to go more rand hedge, more offshore business orientation, and where we do have exposure within South Africa, it's to big liquid businesses. Good and thought about the kind of balance sheet dynamics all around, making sure that if there is any unexpected event in the lead up to that, then it's not the only reason we're doing that. I mean, it's frankly given, how we're seeing issues around some of the stresses that we see in the economy domestically. It's shaping our thinking. But, we're just trying to ensure that we're as, our exposure is as limited as possible to event risk within South Africa right now. Because, I think it's an excellent point that's raised here, is that given the stresses that are building, the possibility we see that boil over in some shape or form, please, let's hope that it doesn't. But, we got to see some little signals of that with the KZN events a year or so ago. And, we're sensitive of how quickly that can develop out of almost nothing. So, we've tried to manage in terms of thinking about vulnerabilities within our portfolio in that context. Less SA, frankly, more rand hedge, and, being very selective among the businesses that we are invested in here with very clear, specific company stories that we're backing.
Mike, and any to further on, any opportunities that you would be watching should we have a very smooth and clear and good election? I'm not sure what a good result would be, but let's assume a peaceful, easy result.
I suppose the thing that I am thinking about a lot at the moment is, it's hardly a particularly original view, I guess, to be quite cautious about South Africa macro. The consumer seems to be under pressure. And that has frankly worked out quite well in terms of investment performance of late. But everything has a point, I guess, at which it becomes consensus. It's overpriced in. Things tend to go further than you think. And it's important, I guess, to have the open-mindedness to accept that a theme has run its course. And I talked about being nimble. And what would be the thing to look out for in that scenario, Dale? Undoubtedly, the consumer sector in South Africa, the retailers have been hammered. And, within that, I think there's going to be a time that comes where great opportunities present themselves. These are high return, quite cash generative businesses. So we've got to be awake to that possibility. That would be the area I would go.
Thank you, Mike. We are at time. Apologies for anybody that didn't get to your question. Mike, that was fascinating. Thank you for spending some time with us today. Thank you, everybody, for staying on. And we will see you next month at the next Essentials. Thank you, everybody, and goodbye.
Great. Thanks, everyone.